Hello, friends, and welcome back to Market Shares. I'm your host, Tony Blodgett, and as I'm looking at the headlines around the mortgage industry, I gotta say, there's a lot going on. What I don't like to see is, sales, slump a little bit over the last couple weeks. Rates tick up, refi applications are lower. It's like, gosh, can we get a break already? But look, a quick look at the MBS charts and you'll see why, we've been on a downward escalator for the last few weeks. But let's talk about what's going on in the market. Let's talk about what the near future might bring for us. This week, as I'm recording this, we've had some very critical inflation data come out. Both CPI and PPI were released this week. And look, there's been so much speculation, especially on part of the Fed, as to what these tariffs are going to do to inflation numbers. And, look, if you combine, CPI, PPI reports, they weren't bad. We did see an increase of 0.15 in the headline number and 0.2 in the core inflation. And look, if you annualize that, that's a 2.4 year-over-year rating, a little bit higher than what the Fed would like to see. But look, these aren't horrible numbers. And I gotta feel like, we've started to see, or we would be seeing, more of the impact of the tariff implementation as, we're here in the first part of July, looking back at, mainly June data. So, to me, these were good reports. Now, when CPI came out, the bond market didn't love it. We sold off. We got an alert to lock that day. Today was PPI. The market actually is doing pretty well on the PPI data, the producer price index. But, I'm not here to do a deep dive analysis on those reports. I mean, there's plenty of podcasts out there that can talk about that, or just sign up for MBS Highway and get all your details. But look, to me, just from a macro view, this was a good read. We did not see these big spikes in inflation that have been anticipated. And to me, it's a little bit crazy at this point that, I've been a little bit supportive on this podcast of, Jerome Powell's desire to wait. Because, I understand, there's a lot of uncertainty and we certainly don't want to go back to an inflationary environment. But I got to feel like this July read showing very benign impacts at this point from the tariffs. When you couple that with the weakness that we've seen in job openings and the employment data that I've talked about on previous podcasts, it really feels like it's time for the Fed to take some action. Now, that is a much quieter voice than the one that you've heard from other leadership in the federal government, mainly the President of the United States and Bill Pulte and others that have been extremely critical of the Fed. Now, I was just reading an article today. I'm recording this just days before this broadcast, that President Trump did say they will not be firing Jerome Powell. And then he goes on to say, well, unless, it's for cause, like, if he commits fraud or something. It's like, okay. But look, bottom line is, don't expect that the president's going to fire Jerome Powell before the end of his term. But what you will see, and what you're already seeing right now, is, an undermining of Jerome Powell's messaging. There's no question that that's the approach that they're taking. They've even talked about, putting in like a shadow Fed, like identifying who Jerome Powell's replacement will be early on. And there's a number of people on that short list. Former Fed Governor Kevin Warsh is on there, Kevin Hassett, Christopher Waller, as well as, believe it or not, the current Treasury Secretary, Scott Bessent, has been, talked about. Matter of fact, I saw an interview with Scott Bessent, and they directly asked them if the president wanted you to step into that role, would you step away from the Treasury Secretary role? And he basically said, I would do what I was asked to do. I serve, at the pleasure of the president. So, that's a possibility that Scott Bessent makes that transition over. But look, the bottom line is it doesn't matter who of this group that it is. I promise you it's going to be someone who's extremely dovish and has a focus on executing on the president's agenda. Now, is that what we really need or want in a Fed president? I'll leave that up for you to debate, in the comments below or in your own conversations. But that's what I believe is going to happen. And so I think there's a lot of headlines right now. There's a lot of noise about Jerome Powell and the rhetoric coming from the Trump administration and Pulte and Bessent and others about what he should be doing. But look, if I just look at the data, if we just look at the facts, to me, there's no question at this point. And even Jerome Powell has said, we are in a restrictive monetary policy right now. And I believe that it made a little bit of sense. I could argue to continue with that until we saw how these tariffs played out. I think we have enough data now with everything going on that it's time to start stepping down rates. I think I mentioned a really great conversation that I had with Barry Habib, where he was saying he feels strongly that we're about a point higher than where we should be to be at a neutral stance. I feel like I align with that. It's at least 50 basis points lower than we are now, if not 100. And there's quite a bit of data to back that up. We need to start making those moves to get to this to this level. And I think when that starts to happen, you guys, these headlines about sales slumping, rates ticking up, and refi applications slowing will start to turn around. So look, I know for all of us in the mortgage and real estate industry, we've been on the edge of our seats for, 2.5 years now, anticipating that we would see some reprieve in interest rates. And I got to say, I don't want to sound like a broken record or a clock that's right, twice a day, but I do feel like we're on the precipice of seeing the improvement in rates that we've all been expecting. We had to get through this tariff stuff. We're not completely through it, but the early indicators are that although there is a little bit of impact on inflation, it's not significant. And as we've talked about before, keep in mind, tariffs do not create long-term inflation. It would be, a short-term event. Tariffs are implemented, and then, inflation, as a lot of people I think lose sight of, is not what things cost over time. It's the increasing cost of things on an ongoing basis. So once inflation happens, then as you continue, if prices don't rise and don't continue to rise above that level, then we don't have inflation at that point anymore. Now, it doesn't erase the inflation that we already had, which is why things at the grocery store still seem super expensive because of the previous inflation we had. But the Fed's not looking to unwind that, and you really can't unwind that. We just need to slow that level to the 2% target, and all indications are, to me, that we're there, and that and that we're going to continue to see mild inflation as we move forward. So anyway, I just wanted to touch on this in this episode that, ignored the noise a little bit about everything in the headlines. I don't think Jerome Powell's going anywhere, but I don't think he's going to change his position based on the rhetoric. But I hope that he changes and starts to ease rates based on the data, because now I feel like we have some data that is post-tariff, and the job numbers are not super strong, and now the inflation is not going crazy. So why not get us to where we should be anyways? He is late to the game, in my opinion, but now would be the time. So I would look hopefully for a reduction in rates at the next Fed meeting. We'll see. We'll see if that happens. That's just my opinion on what should happen based on my analysis of what I see going on. And it is going to be interesting as we get closer to the expiration of Jerome Powell's term as the Fed president. Who gets identified, and then, oh boy, it'll be interesting to see what a new Fed president does that's selected by by Trump and how much they really work to drive down the cost of money. And remember, it's not just, this is not just for mortgage rates, right? There is a lot of desire and pressure to bring this down because of the cost of the U.S. government's debt load, the cost of servicing that debt. That's way more important to the president than mortgage rates are. But, you know, we benefit from that in the mortgage industry. And as consumers, if his fight to push down the cost of money, if you will, for the federal government, it'll help everybody downstream, and the mortgage and real estate industry being one of those areas. So we'll keep a close eye on this, you guys. I appreciate you tuning into Market Shares each and every week. And more than that, I appreciate you letting people know about what we're doing here at Market Shares. It really helps a lot, and we'll keep you informed as things continue to unfold. Until then, take care and bye for now.